Good morning, welcome to end of week Ainslie news. It's Friday, the 19th of February. Today we're talking taper tantrum or Volmageddon ahead. The everything bubble is starting to look increasingly shaky. Last night, literally everything except platinum, which seems bulletproof at present, was sold off. Everything. Even the Bitcoin rocket briefly leveled out, but admittedly, Ethereum surged again to new highs. Whether cause or effect, that of course included US Treasuries, which saw 10-year yields rise above 1.3% and into territory that's becoming scary for this bubble, as Bloomberg macro strategist Laura Cooper penned overnight. Rising US real yields could eventually derail the everything rally. Gains across stocks, credit and emerging markets are predicted to forever lose monetary policy, and lofty valuations are harder to sustain when conditions hint at future tightening. Stimulus-fueled growth prospects have rekindled the typically positive relationship between the real US yields and inflation expectations, and that can trigger outflows on higher-yielding assets like equities. Market-based inflation's expectations are comfortably priced for a medium-term overshoot above the Fed's 2% target. Near zero Fed rates sent real yields deeply into negative territory last year without the growth element to boost nominal yields. As a massive fiscal impulse underpins the economic recovery, a corresponding increase in policy tightening expectations could drive up the inflation-adjusted benchmarks, removing a key tailwind to the broad risk rally. Here's that canary in the coal mine chart here. A continued creep higher in US real yields could cause trouble. Up it sneaks. Throw this into the cocktail of breaking news that in addition to Biden's $1.9 trillion relief plan and the $4 trillion already unleashed by Trump, the White House is now proposing a $3 trillion Build Back Better program of infrastructure and other job-creating initiatives. This tsunami of spending, both more debt on things more likely to increase inflation, and emptying of the huge Treasury General account, the TGA, has some analysts concerned we could see the equivalent or worse of the 2013 so-called taper tantrum, as Cooper explains. The Fed risks getting caught behind the curve should tapering bets ramp up as the economy recovery extends. That raises the odds of a repeat of 2013's taper tantrum. When real yields rose sharply, more than the nominal rates, the repercussions rippled across risk assets, and over a 4-week period the S&P fell 6%, EM equities tumbled more than 15%, and the speculative grade credit saw spreads blow out by 100 BPS. The other thesis or concern in this near record high VIX, or the volatility index, shorts amid this tectonic shift could see a repeat of the February 2018 so-called Volmageddon, equities volatility shock that saw the S&P 500 drop 6.5% in just 2 days, triggered by increased Fed tightening concerns. Yes, we get the irony, but remember that this is a market hooked on stimulus juice. Either way, we are now at a very interesting juncture in financial markets. Whilst gold and silver got sold off last night, so did the USD, and so did shares. This is not a normal functioning market of historic correlations. What history does tell us is that when financial assets crash, gold and silver rise. History always doesn't repeat itself, but it certainly often rhymes with what's happened before. Hope you enjoyed news today, everyone. Remember ainslieBullion.com.au for all things physical, gold, silver and platinum. Interested in cryptocurrency, AinslieWealth.com.au, and check out goldsilverstandard.com if you're interested in our own cryptocurrency that's built and backed by real physical gold and silver. Enjoy your weekend, and we'll catch you on Monday for more news.